we're almost always a buyer of stocks, and we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down.
Have you listened to Warren Buffett's investment rules and implemented them yet? You would have been a rich lad by now if you had. But wait, it's not too late. You can still listen to his investment rules, implement them, and quadruple your wealth. Warren Buffett explains why and how investment is not as complicated as everyone assumes it to be. The ones who fail to understand it lag, while the rest upsurge. So let's take a look into Warren Buffett's top 10 rules of investing that will make you super rich. Watch the video till the end to unfasten the hush-hush, which has made him a billionaire and the 8th richest man on the globe presently. Before the video starts, don't forget to click the subscribe button and hit the bell icon to never miss an update. Get out of cash. Warren Buffett gives a simplified solution to all your investment concerns. He affirms why investing in assets is an important and beneficial venture instead of keeping the cash safe in your bank account. Currency is highly volatile in nature on the global stage. If one day Chinese yuan dominates the money market, the other day is the US dollar. You never know what happens to your cash in the next moment. That is why Warren says it's better to invest and double the savings rather than letting the inevitable happen. He also draws an analogy here. Imagine that you have invested half of your savings in a business, stocks, or cryptos, and imagine that the market is on boom. You would have doubled your investment, isn't it? Warren says cash that is not invested is worthless. Indeed, it is. I mean, what if something like Corona happens once again? You already know how people across the globe lost all their savings to the pandemic. When losing is inevitable, why not make an effort and double the savings? But the complications arise when people are left with a surplus cash. Warren Buffett says he would rather have a good business investment than have a surplus amount of cash laying around him because it is a hedge against the dollar, as he likes to call it. Temperament. It is nothing new that some stocks sell at very low prices. If you're not wise enough, you will wait till your share price drops to exorbitantly low levels. Warren Buffett believes that you don't have to be an investment advisor to figure out one's next move in the stock trading market. All it takes is temperament. He even says that high IQ is not useful in the stock market. He even asks you to sell your IQ if you have any extra, because that's how significant Warren thinks IQ is for understanding stock markets. From a very early age, Warren Buffett realized that the right mindset and basic knowledge is what is needed to excel in the stock market. Blurring out people's opinions regarding your investments, then picking yourself up after facing failure is everything you need, because at the end of the day, investment is all about future and returns. If you have a temperament that makes you step up and act upon your decision, then congratulations! You are much more capable of figuring out when to invest and withdraw. The investment business requires nothing else but 3 things: temperament, some factual knowledge to make an appropriate decision, and taking resolute decisions. Go big. Never let your instincts or sixth sense obstruct you from seeing the bigger picture. Warren Buffett reasserts that instead of taking 100 small steps to your one big goal, make one smart move that helps you leapfrog and land on your destination directly. He draws up another analogy here and asks you to imagine that you have 20 punch cards and says that you can only use these 20 cards to reach your goal. What would you do then? You will then use each card when it's required. You take calculated decisions. That's what stock market and investing is all about. Taking calculated decisions is always looking at the bigger picture. So Warren asks you to focus on the shark instead of the small fishes in the ocean of stock market. Of course, you had to start small and smart, because you cannot invest big right in the beginning and expect to become a billionaire overnight. It takes wisdom, smart and swift decision-making ability, consistency, perseverance, and investment skills to reach the mark. Invest in yourself. Warren Buffett advocates that investing in yourself is as important as investing in the stock market. At the end of the day, you have to upskill yourself regularly to understand and keep up with the market updates. You can start with basic knowledge, but you can sail the ship to its destination with some basic knowledge. You may have a limited understanding of how it all works, but you should strive to attain and achieve superior knowledge and understanding about the market dynamics. This is the reason why investing in yourself should be the top priority and the first step towards financial excellence. He firmly believes and preaches that your talent is the only thing that no one can grab away from you. Your skill is your biggest asset and investment. However, you need to refine your skills, learn from experts, and develop great observation skills. To start with, follow the stock market news and happenings closely. Either seek guidance or mentoring directly, or follow an expert's life and success cycle closely to learn from their mistakes. Observe how different people think different, save differently, and invest differently. Understand the patterns. By putting the right ideas in your mind and taking calculated steps in the right direction, no one can stop you from achieving what you have always aimed for. And for that, keep upskilling and improving yourself. Circle of competence. People generally take a lot of wrong steps, and trying to cover too many things at one time is one of them. It's okay to not know everything. You can aim to be a jack of all trades, but try not to end up being master of none. As mentioned by Warren Buffett earlier, try starting small and smart. You should be aware of your strengths, weaknesses, and your circle of competence. You should, of course, grow out of your comfort zone and experiment while you're hustling, but not in the beginning. Beginnings require stability, certainty, and calculation. Be specific about your targets and the path you choose. Don't let someone else's achievements or wide expertise fade your vision. The founder of IBM once confessed that he is not a genius, but he is smart enough to identify his special skills and focuses on them no matter what. Nobody other than you knows your expertise, strength, and weaknesses. Insecurity, imposter syndrome, and dissatisfaction are a common phenomena in this journey, but don't let them take control over you. Clarity of vision, focus, and determination are as important in this journey as your skill. Be undeterred in your adventure. Always be mindful and awake of your weak points and strengths, and keep honing your skills. Think long-term. Long-term investments are the toughest. It requires patience. For example, if you own a farm and work on it every day to measure the growth rate of your crop, let me tell you, it's a waste of time. The farm will grow at the same pace with the right inputs, with or without your supervision. Hence, giving the farm the right amount of attention and adequate inputs helps you reap long-term benefits. Warren Buffett revealed that back in the 1980s, he bought a farm. He went there just once to supervise it and then left it to his son. He believed that the farm will still grow without his attention. No matter if he would supervise it or not, the situations and natural factors and the condition of the market will remain the same. This is called a long-term investment, believing in your decisions and eating the fruit only when it is fully ripe. Remember, this doesn't mean that you completely ignore the progress and market conditions altogether. You still have to be mindful of the market changes. Stock equals to a part of business. Warren Buffett mastered the art of not getting emotionally attached to his stocks. Warren once shared that his mentor, Ray Dean, once suggested to him not to invest his emotions in the stock. That is, he suggests you to stay unaffected no matter how your stocks perform. Do not celebrate if your stock booms, and do not feel disappointed if it crashes. You are an investor and think like one. No matter how your stock performs, you need to constantly assess the market position and gauge the probability of your success. Learn accounting. Lack of accounting knowledge is similar to moving into a foreign country without learning their language. If you need assistance, feel free to take it, because learning accounting is essential. Warren Buffett learned the basics of accounting from the newspaper by the time he was in his later teens. Hence, he attests a huge part of his success to his learning habits. Without understanding accounting, you will never understand your investments and returns, and hence get stuck in a toxic circle without growth. Think for yourself. Although no one wishes to say it out loud, this is the truth. No investor thinks for the well-being of his fellow investors. It is you that matters, not someone else. Always learn to prioritize yourself over others. Think for yourself. Take calculated steps and think how it benefits you at every turn of your journey. Does it sound selfish? Yes, it is. But what is wrong with being selfish? As long as you are ambitious about your goals and not harming anyone and resorting to legit tactics, do not let your guilt question your conscience. Have a margin of safety. Never invest everything that you have. No matter how much anyone preaches about the potential of investing, there is always risk associated. Hence, always have a margin of safety. Invest 50% of your savings with risk and be very calculative and picky with the rest. You can either choose to invest them or just let them sit in your bank account idle. It doesn't matter much. Warren Buffett gives a simple example. Suppose you have a truck weighing 9,000 pounds. You obviously wouldn't take the risk of passing through a bridge that says the limit is 10,000 pounds. You would rather take the bridge whose limit is 20,000 pounds. That's what it's about. By investing everything, it boils down to prosper or perish kind of situation. Hence, saving is risk aversion, and it helps you avoid losing everything that you have.